Okay, folks, this is the last chapter for the Unit 2 review, and we're going to talk about savings for the future, starting with the why, the where, and the how, and then savings options, features, and plans. So the slide that I have here on needs would fall under the why category. I think that short-term needs are something that most people your age can really relate to. Usually you have to pay for things out of your savings at this point, so if you are making an allowance or an hourly wage, that's probably covering anything with emergencies, spending on vacations, social events, if you have a car repairs, and certainly any major purchases that you're interested in making. The other thing that I think long-term needs would be something that you want to think about now, but not necessarily starting to save for. So eventually you are thinking home ownership, maybe even college education could be in this category as a short-term need if you're a senior. Retirement is in the future, and investing. So the difference is really the time. These are usually things that you're looking for in a short-term period of time, whereas this is a list of things that would require years of planning and savings. So if we go into the why of savings, it's for your short-term, your long-term needs, and for financial security. So you don't want to live paycheck to paycheck. You like to have nice things, or maybe you would like to invest in travel, and that would be the why. The how the money grows, how it works in savings, is somewhat outlined below. Some of these blue words are the vocabulary terms, as usual, that you would want to focus on when you're reading the chapter. But we'll start with the word principal. Principal is used in this course in two different ways. Principal could be the amount of money you deposit into a savings account, so what you're starting with. But principal will later refer to the amount of a loan that you originally take out before interest is applied. So let's just say that I have a beginning balance of $100 for my savings account. That would be my principal. Interest is what you earn on that principal. And there is interest that grows on your savings account because the bank is actually loaning out your money to other people and collecting interest from them and sprinkling a little bit of it back into your account and using the rest for their own profit. So by no means is a bank taking your money and holding on to it completely for free just out of the kindness of their heart. They're using your money to grow more money. So interest can be in two different ways. The interest that you earn on an account, but also when we get into loans, interest is what you pay because you're borrowing money. This chart shows a 6% interest rate. That's very high. If you do your research and you look and compare bank options right now, you are definitely not going to find a 6% interest rate on a savings account. It's more like 0.01, which is a shame, but for this example, just to show you the improvement and the difference it makes, here's what this looks like. So if you are talking about compound interest, after my first year with 6%, if I've done nothing to the account, I've earned $106. Compound interest says that instead of using my principal for the following year, it takes the ending balance. And so it starts the next year on 106, and then it calculates the 6% interest on that, which gives you $6.36 interest, which then leaves you with $112.36. And again, instead of starting the next year at my $100 principal, it starts it with the previous balance. So compound interest is a great thing. It's principal that has interest growing on it, and it's interest on interest. APY, you're going to hear used often, is the interest rate. So it's stated on a yearly basis, and you're going to learn more about APY, especially as you do some research on banking, but that's what they're talking about. Annual percentage yield is really the interest. And then finally, the question you want to ask yourself when you're looking into savings, besides the why would I save and how does it actually work, the where is going to be local banks, any kind of credit unions, things like that that offer savings accounts are where you would get a savings account. The next slide just shows you another example of compound interest with additional deposits. The last slide just showed that each year the new balance was basically a little larger just because of interest. It was a set it and forget it account. Somebody put $100 in it and just let it grow. But the reality of it is, every time you make a deposit, you are increasing your principal and you are increasing the amount of interest you're earning. So for year one, you can start with 100. You earn 5% interest, so that's $5 on 100. So your ending balance is 105. If I move that over here, the calculation below kind of walks you through the steps. You had your beginning balance of 105, but you were smart enough to put another $100 in it. So now you have $205 at 5% interest. So you are now earning $10.25, which brings you up to $215. The next year you're starting with the $215.25 and you add another $100. So most people, this would be a set it and forget it account as well. Maybe you just make a one-time a year deposit. The reality of it is you are really looking to have your savings account grow. You should be putting in different deposits at different times of the year, maybe on a monthly basis, maybe on a weekly. They talked about selecting a savings plan in this chapter, and the words that you really want to be aware of are the words liquidity and safety of principal. Liquidity, which actually should be highlighted blue, is a word that talks about how quickly can you turn your savings into cash when you want. So the important part is, when we're talking about liquidity, will I be able to do it quickly, and will I have money at the end of it? So for example, your savings account is very liquid. I can go into my bank right now, I can close out my account, and they're going to give me the cash. Something like a car is not as liquid because you have to find somebody to buy it. So it might take you a little while. It's not instant. The other problem with selling a car is that it might depreciate in value, meaning if you spent 10 grand to buy it, you might not get 10 grand back. Whereas savings accounts are extremely liquid because you get the exact amount out. The other thing you should think about when you're selecting a savings plan, or why you should select a savings plan, is safety of principal. It's basically saying that you're protected. We talked about the FDIC in the last chapter, and that's really the idea that you have an insurance policy taken out, and if the bank were to explode, go out of business, fall off the face of the earth, your money somehow would still be protected. Selecting a savings plan is a convenient option because there are locations, and even if you do it online, you can still have access to it, and there's a lot of services offered. You want to continue to think about earning interests. So another reason to select a savings account is the yield. You can definitely find several different types of savings accounts which earn you more money than just a regular savings account, but you should do the research. And another reason, or another thing you should be aware of, is the fees and restrictions. So not everything is going to be 100% free, but a lot of the savings account options are very cheap in their pricing. Certificate of deposit, also known as CD or time deposit, is a deposit that has a specific interest rate and a specific amount of time that you need to leave that deposit sitting and building in order for you to earn its full potential. So there's typically a minimum deposit. Some banks have a minimum of $500, some offer $500, $1,000, $5,000, $10,000, but what they're telling you is if you put that $500 in, let's just say you start with that, and you promise and you don't touch it for 10 years, when you come back to get your money, when it's reached its maturity date, it'll be worth $1,000. Now, that's not a specific. There are many different options and many different interest rates that could be applied with a CD, so they don't all go from 500 to 1,000. You could have different intervals, but the idea of an interest rate is exactly that. You're going to leave in the money for a certain period of time, and the bank is going to invest it and loan it out and do many different things with it, guaranteeing that you're going to make a certain amount of interest on it. And as long as you're patient enough, you will get all of that and then the growth when you actually go and cash in. If you take the money out before the maturity date, there's an early withdrawal penalty. So you might make a little interest on it, but you won't get to your full potential. A money market account is a type of savings account that offers a more competitive interest rate than a savings account, so it's just another option for you. You could have a deposit account or you could have a money market fund. So it's higher interest rates and there's more details on the different types in the book. But we will talk about money market funds in a later chapter. Don't get the money market fund and the money market account confused. These are two very different things. The last two things we're going to discuss are what's a direct deposit and an automatic deduction. And this is a mix of your banking chapter, but also touches on chapter 10, which is the one that we're discussing right now, the savings chapter. A direct deposit is exactly what it sounds like. It is when your net pay is put directly into your bank account. You don't actually get a paper check to cash or deposit. It's already there on payday. Some institutions will give you a paper copy of your pay stub just so you know what has been deposited, but most of them try to do this to maintain a paper-free situation. So like for South Brunswick, teachers have a log-on for a computerized system so that they can see a physical copy, but we don't actually get a paper copy. You can print it if you would like to. Direct deposit goes right in, and some of us, like myself, might have it split into two different accounts, one of them to pay my bills, and some of that money goes into a side account for my summer savings because teachers don't get paid in the summer at South Brunswick, so I set up my own deposit that goes into a side account so that I can get checks back in the summer just like I'm still getting paid. Automatic deduction is another way that your bank can service you, and what you're telling them is to move your money from one account to another at regular intervals. So let's just say I get paid on the 15th of every month. Instead of splitting my direct deposit, like I talked about above, what I might do is ask them to take out $100 of my direct deposit on the 16th and put it in a savings account. So I get paid on the 15th, an automatic deduction is taken out on the 16th. It could also be something that you're moving from one account to another. You could have it taken out and put into an investing account. So it goes into your bank account and then a few days later it's invested. So it's automatically deducted. And then the last term that they talk about with automatic deductions going along with your payroll or your pay is a payroll savings plan. And this is having your employer make the deduction for you. It's not you that has it set up. And then it goes from your paycheck each pay period into a side account. So these are very similar. One is authorized by the employer. One is the one that you might set up for yourself. They're both automatic deductions, but if you're going to do an automatic deduction without your employer, you would have to do it manually. If you're going to do it with your employer, they set it up for you. Stay tuned for some embedded questions, and this is the end of Unit 2. Again, please reread your chapters in the textbook and make sure that you are keeping up with these videos on the deadlines posted in your pacing chart and on Google Classroom. And that would be all for Chapter 10 and the end of Unit 2.